Welcome back to the podcast. It is not every day that you get to speak to one of the true legends of the industry, a titan who is universally respected, an inspiring figure. So how lucky for Cliff Asness from AQR to get to be on the Phil Bach podcast and get to talk to me today.
I was going to say Titan. Titan sounds like I've put on a few pounds.
Well, truly, thank you for the time. It's great to be here. I'm in your office in Connecticut and at AQR. And I thought we'd kind of jump right into the factors, start in the middle of the onion and kind of work our way out. The market right now is completely wild. We've got concentrated index funds to the point where the S&P has failed 40 Act diversification requirements.
That's funny.
A lot of people have made a lot of money being very ignorant of value, just buying at the market or buying based on narratives. We're looking at, an unprecedented move in NVIDIA. So I guess the question, a lot of people are saying this time is different. The question is this time different? What is the efficacy of traditional factors in this type of market?
Yeah, I would say a few things. First, and I've looked at this, Owen Lamont of Acadian has looked at this. I don't think the concentration is as radically different than the past as some do. It is certainly a concentrated market, but we have seen pretty concentrated markets in the past. You can go back to the 1950s and see markets that were dominated by a few firms. I don't take a very direct signal out of that. Not surprisingly, and maybe a bit self-referentially, look at things we've looked at since the dot-com bubble in the late 90s. The dispersion between cheap and expensive stocks, defined very simply, just in terms of multiples. This is not a holistic Graham and Dodd kind of cheap and expensive. It hit, by how we measure it, world record levels at the kind of end of the 2020 COVID year. It's still in the low 80s percentile. So I find that a more direct measurement of our prices a little odd. It's also, and this is important, and this goes to your question about factor efficacy. That's not dependent on a handful of stocks. That is a very diversified set of long cheap against short expensive. I've made this joke many times in my career, but when I speak, I often get the sign wrong. When we trade, we get the sign right like 3 out of 4 times. You're not laughing. We get it right all the time when we trade.
We'll take the absolute value of everything.
Yeah. The other version of that joke is in academia, all you have to do is show there's an arbitrage opportunity. In real life, you care about which side of the arbitrage
right.
you're actually on.
Right.
But most factor investors, and I'll talk about it like it's all, but I always like to keep in mind that how we do it and how others do it, there are always subtle differences and whatnot, are dealing with very diversified portfolios. When I talk about both factors and real life, if I'm looking at a global portfolio, if we're running a market-neutral global portfolio based on a multi-factor model, it could have 1,000 longs and 1,000 shorts. No one stock, no handful of stocks should drive what we're doing. Sometimes handfuls of stocks can be indicative of the general zeitgeist of the market, but often it's a little counterintuitive. I will put this solely in a bragging sense. I won't give you any of the examples that are bad for us, but last year was generally considered a blowout, terrible year for value investing. Our versions of value were up last year. That is not magic. I'm not claiming any particular genius. I will claim genius later about many things. But one, the versions people look at tend to be U.S. based. They tend to use the major indices, which are cap weighted, which really means they are the Magnificent Seven against everything else. We and many other quants, this is bragging maybe about the field, not about AQR in particular, tend to look at very diversified portfolios, and many of us, not all, tend to take out as much as we can of the industry and the sector bet. Mm-hmm. I'll tell you, AQR, we wrote our first portfolio before we were wrote our first portfolio. I've spoken better than I am today, Phil. You're bringing out the stumbles in me. Wrote our first paper on this in 1995, a handful of us who were at Goldman Sachs. that we think most quantitative factors do better if you take out the industry or sector bet. The apples to oranges comparisons of, I always say, tech versus textiles is a hard one. Obviously, that also reduces the bet against something like the Magnificent Seven.
Right.
And finally, I mentioned that people look at the U.S. Value in the U.S., even the way we measure it, last year was kind of flat. If you compare that to value indices, it was a home run, but you don't make money from flat. Value globally was actually quite strong. So the U.S. was a bit of an anomaly. So I think concentration, unless it's indicative of some total mania, I do think, and as an ex-Gene Pharma student, it still pains me, but I use the term bubble. I think I've lived through a couple of them. When you're plus or minus 6 months around a major bubble peak, or maybe whatever the opposite is, a depression, I think there can be moments where the bellwethers are just telling us what's happening throughout the whole market. I remember in the dot-com bubble in 99, 2000, value as we defined it lost in, I'm going to round, in 50 of the 50 industries we look at. Obviously, there was some animal spirits that you probably could have captured just by looking at short cyclicals and long a few dot-coms. But aside from that, we're 3-4 years off the peak of this bubble. Again, how we measure it. And when you get there, life becomes much more eclectic. And I prefer the good to the bad, obviously. You can lose from this as well as win. But it's much more about how you do it and how you design it than it is about these giant things. So I don't particularly fear the Magnificent Seven, because I don't think I'm particularly short the Magnificent Seven.
Right, and you've, you've talked about how, there may or may not be a size factor at all. So when you talk about
no, I haven't. I've said there isn't a size factor.
So yes,
you're being too nice.
How do you get there? Because I spent a long time early in my career as a product manager on RSP, the equal weight ETF, and I built a product called reverse cap weight, which was the inverse reciprocal market cap, which nobody bought, and sadly we had to close it. But the timing, you can imagine, we launched that in 17, right? And I thought, this can't possibly, these FANGs, they can't possibly, take a bigger percentage of the pie. And lo and behold, here we are. So
yeah, those words, I've made that mistake myself of saying it can't possibly get crazier than this. Those are you should always check. It's when you're finally saying, "Oh, it's just going to keep getting crazy." That's when it stops. Write that down. It's a highly technical quant model for the whole thing. The size effect. I got to get my definitions right. We do believe, certainly gross and probably net, they're more expensive to trade, and that's the difference. Most so-called anomalies, they can be risk-based, they can be behavioral-based, I'm just going to call them anomalies, are more efficacious among small. So a lot of small tilts that people have on, I think actually end up being long-term good things, because what they're doing is some strategy that does tend to work better there. If you look at the Pharma French data, value in big caps, again, they define it very simply, as they should, because it's a bellwether for everything, but just price to book among big caps is hardly a positive spread ever, even before the kind of value problems of the last 10 plus years. All of that kind of adds up to, when I see a lot of people who are real world like small, I think they often really are liking what they can do within small. So sorry, go on.
So it's not small value; it's value within small.
Yeah. Huh. And you can even say small value. If value within small works better, then even not hedging the other side, even just buying small value, does get you some anomalous returns. So I have no problem with any of that. Where we do differ is on the pure size effect, which is not doing another strategy. It's not buying a subset of the small. It's not buying the small value. It's the full set of small stocks, however you define it, against the full set of large cap stocks. The initial result, kind of bonds, early 80s kind of research, was that small tended to beat large after accounting for beta. That's, step one in academic research, and in applied research is always, all right, if you're making more money, is that just because you're taking more risk? With the most prominent one that almost no one disagrees with, are you taking more market risk? Right? And the answer was yes. That has come under increasing pressure over the years, partially because it hasn't done as well out of sample, but most things don't do as well out of sample. I don't mean that as a cynic. We often, as a rough rule, say if something's half as good out of sample as it was in sample, that's a home run. I like to say when a young person at AQR, and they're always young people, come and tell me this strategy is a 6.32 expected return, and I'm like, do you understand we're lucky if we get the sign right? I don't need a second decimal point. But so that was the result. Out of sample's not been as strong, but more important, the original results are not as strong. This sounds strange to say it that way, but if you redo the tests over the same time period, they're not as strong. And it's not because anyone's doing something wrong. It's because they make the databases better over time. And there are all kinds of issues. What do you do with a delisting firm? You have to come up with what was the final return on someone who owned that. And I believe what's turned out is the estimates were too optimistic. And because small firms delist more than large firms, you were overestimating small returns more. The second, and the one we focused on and maybe made a contribution on, was in estimating beta. Somewhat for different purposes, going back in time as far as Scholes-Williams wrote a paper on this, I don't remember what year, a long time ago. If something does trade, this doesn't work for private equity, but if something does trade just not as frequently as the index, meaning it can be 3 days since a stock has traded, it's a micro cap, then you will underestimate its beta. And that's kind of obvious, right? If one great way to seem like a beta of 0 is not to record the moves when the market moves. But one technique that I don't know if they came up with or if they applied, but I'm going to give them credit, is standard weight estimate beta is to regress the return on the market. If you regress the return on the market plus several legs of the market, you can pick up this effect. Because if it doesn't trade all the time, and you're regressing today's return on the market return, if it moves at a leg, it's moving at a function of the prior few days.
Right.
Also, and if you add those up, you get a better estimate of the beta. And when you do that, you really drive the whole thing away. This is not a terrible thing. It doesn't make small caps a bad deal. We only drive it to 0. We don't drive it to negative. And again, if you have good other strategies, you really might be well served by having more small than large, because those strategies can shine more. But it's a very long-winded way of saying we are not believers in the straight-up old-school size effect.
I got to wonder if the profile of a small cap, certainly a micro cap investor, is very different than the profile of somebody who's just buying beta or derivatives on beta that are pushing up ever higher the most expensive stocks. And I wonder if it's a function of that the people who are mining for value in the small and micro cap space are naturally going to bring the stock back up to its intrinsic, whereas you don't have that in large cap anymore.
Yeah, that's actually a fairly deep question, because it begs another question. Is it good or bad to have other people bringing things back to fair value? Implicit in the way you phrased it is it's good, because you get to realize the value. It also, if that's the case, and I can't prove it's the case either, if that's the case, things will probably tend to deviate from fair value less. And this comes into a much bigger topic than just small. This comes into, do you want the market to be more or less efficient than it is if you're a long-term value manager? And here I'm using value in a much more general sense than just the academic multiple sense. I'm more Graham and Dodd, value conditional on growth and profitability and the risk level. Is it a good buy? If you're in a world, and I do believe this, and I'm kind of skipping to the end. This is one of my main things I'm talking about these days. I do believe over my career the market has gotten somewhat less informationally efficient. We can all debate a lot of reasons for that. I think the common belief is probably automatically believing things get more efficient because the world tends to get better, and technology and data availability and ability to go online and know everything in the world about an individual stock in 8 seconds that used to take us 8 days. That I don't think that's what makes a market efficient. I think it's processing information. And to some extent, there are many candidates for this. You could talk about the move to passive. You could talk about 10 years of ultra low real interest rates. But I think the very availability of information itself can have the opposite effect. And the internet itself, I'm going to blame the internet. It's a popular thing these days. The wisdom of crowds, which is partially what underlies an efficient market, right? This idea that we're aggregating information, works when the crowd is largely independent. When Regis Philbin lets you ask the crowd, and you get 400 people in the audience on some obscure issue, most don't know it at all, but that averages out, and the 30 versus 20% are the right answer. Well, the wisdom of crowds becomes the mania of mobs when the crowd all gets to talk to each other. And the internet and social media in particular are the greatest vehicle ever for turning a wise crowd into a maniacal mob, if I may possibly exaggerate a bit. So let's assume the world has gotten less efficient. Prices, the way we measure it, I've mentioned they hit the biggest deviation ever in late 2020. Maybe that's some anecdotal evidence in that direction that there is less of a bound. Getting back to your question, is that a good or a bad thing for an active manager trying to find true value? Quite simply, I will give the wishy-washy answer to my own question of both. If you can stick with what you do, I think long-term it is probably better. It's almost definitely better. You make your money because prices are not perfect, right? If prices were perfect, we know what happens. You make no money long-term. So if you're making money from an inefficient market, if it gets less efficient, you'd think over time you make more. It gets harder to stick with. The extremes prices go to and how long they stay there with less efficiency. And this gets back to your example of fewer people bringing those prices back in maybe the large cap versus the small cap area. So I tend to think of this, I can't tell you what the net is for every person, but I can tell you I think it's fair. If I'm right, which is a giant if, markets are easier to beat long-term if you're a Vulcan. And a Vulcan who manages money for Vulcans, and you just stick with it. But it probably is harder to stick with, and that seems very natural to me.
So if the market is, there's total dispersion and narratives are driving things, and let's take NVIDIA as an example, right? There is no valuation at which people say the market rejects it, right? The narrative is still strong. I don't care what the value is. It's just there's always a greater fool coming. It's always going to go higher. You can measure that as an asset manager. You can, let's say, ride momentum and you could say, all right, I'm going to take a value approach and I'm going to take the counter. Whatever it is, there's a dispersion that gives you opportunity for alpha. From the point of view of the fund manager, maybe it's a good thing. But from the point of view of the market as a whole, is that healthy? I mean, doesn't that introduce all sorts of fragility, all sorts of potential for crash? I mean, eventually there has to be some sort of mechanism where the stock, where the ticker and the company have something to do with each other, right? I mean, eventually, we're not, it doesn't have to be pure, all right, we're buying the future cash flows, but there has to be some sort of connection, right, between the company and the stock, don't you think?
Yeah. Well, first, I'll give the cowardly disclaimer. I don't do individual stocks. The amount I've heard of NVIDIA, I'm kidding. I still pay attention to the market, even if we're not trading individual stocks, and I'm a computer gamer from way back, so I've been buying NVIDIA products from when they were a humble graphics card for the high-end geek market. Though on NVIDIA, again, I do not get involved in these battles, and I have very little to contribute. But I don't think, from what I've seen, that they're priced nearly to what I would say a .com was priced in '99, 2000. Those were companies without earnings who were priced to astronomical levels. I think there are scenarios. I'm not saying they're the likely scenario. As someone who still believes in value, I think on average, whatever someone's paying a lot for, they're probably overdoing it by some degree. I don't think you can make a case NVIDIA is 10 times overvalued. And back in, again, the .com bubble, I think you could make that case about many a firm. When it comes to the whole market's health, I just look at market valuations. If you're a Schiller Cape fan, and I'm old enough to remember when he introduced the Schiller Cape, it was the inspiration for Alan Greenspan's famous irrational exuberance comment, which then Bob titled his book after that a few years later. I think we're now in somewhere like the low 30s. Again, I'm going to use the dot-com bubble as the gold standard of insanity. By our measures within stocks, late 2020 was more extreme, but for the market as a whole, it didn't come close to March of 2000.
Right.
In March of 2000, we saw a Schiller Caper for around 44. My colleague, Antti Ilmanen, is kind of our house expert on long-term expected returns. He wrote a book called Expected Returns, and then wrote a book. I always mangle the exact title, which is embarrassing because I wrote the foreword, but Investing in a Low Expected Return Environment, where he got extremely lucky, and he'll be the first to tell you that because the book came out in late 2021 when the forecast for global stocks and bonds portfolio was the lowest ever. It's only based on valuation. If you're going to forecast long-term, call it 10 years. Momentum, doesn't matter. Nothing matters, except if you buy at a high price, you tend to make a little less money or a lot less money if it's a very high price, and vice versa. The reason it was the lowest ever when he made that forecast was both stocks and bonds were extremely expensive. Bonds were about as expensive as we've ever seen, real yields around zero. And stocks were not dot-com levels, but they were in the 30s, Schiller Cape, which is quite high. The long-term average is 15 to 17 kind of number. Since then, we've seen bonds correct a lot. I said Antti got lucky. He got lucky because 2022 became the worst year for 60-40 we've seen in at least a long time. Some people say ever. It depends how you measure it. So it's good timing to write a book like that. But on his estimates, Global 60-40 is now less attractive than history. Historically, it makes 4.5-5% over inflation. He had it priced to well less than 2% at the end of 2021. Call it in the ballpark of 3% now. Less than history, but we never made a hero market timing call on this. It's not what we do. But at 1.6, I think we were willing to go, yeah, we probably bet that's not going to stay long term. That's not the new normal.
Right.
At 3, it may be the new normal. It's hard. It's hard. 3% now is better than 3% in the prior 100 years because you get to keep it. Over the prior 100 years, you paid very large fees, and generally almost everyone owned concentrated portfolios, so they were seeing double the vol and a lower top line. So 3 today might be equivalent to...
And that's 3% on a 60-40 portfolio over inflation.
Over inflation.
Oh, yep.
Which doesn't sound like a ton until you realize it's 40% bonds and I'm subtracting out inflation. It's a pretty decent return. All of that adds up to me saying, I don't necessarily buy your original premise that everything has to crash. When Antti makes a forecast, which are kind of the official AQR 10-year forecasts, which I should tell everyone we do absolutely nothing with except tell people about. We don't trade on 10-year forecasts. Let me give you a segue on the danger of trading on a 10-year forecast. Rarely, this does happen, but rarely do you get a 10-year forecast of negative returns.
Right.
A much more common thing is when markets are expensive to say, we expect the next 10 years to be considerably less positive than normal.
Right.
If the action item is, it's expensive, then sell it, underweight it, or short it. You know what you get for shorting something with a lower expected return but positive one than normal?
2023?
You get smaller losses than you would have gotten otherwise. You get to go to your client.
Right.
The bad news is we lost you a lot of money. The good news is we lost you less than we would have over the 20th century had we done the same thing. I have historically found people don't get very excited about that. So all of this is saying we're wusses about the short term. We're not short-term market forecasters. We are wary of the fact that returns are lower, expected returns are lower, and all our theories that maybe that's acceptable could also just be wrong. Maybe the world will say, no, we need what we needed in the 20th century, and we will need to see some mean reversion. But when Antti makes our kind of official forecast, we do not assume mean reversion. There are many firms out there, or at least some firms out there, who do some similar things, who take the current level of valuation, even without mean reversion in prices. You make less if you buy cash flows for more expensive. Everyone understands this with a bond. You're buying a bond at a lower yield. Equities really aren't different.
Yep.
it's not as dire as those, according to us, as those who automatically assume at the end of 7-10 years we're going to be back to historically normal prices, which for equities would be, near a 50% haircut, and that would be ugly.
That's a big number.
That's a big meatball out there.
Yep. Let's jump to private equity. One of my favorite topics, and I know one of yours as well. One thing that, one of my real pet peeves, and this just came up like a week or two ago on Twitter, in a huge publication where the concept of the liquidity premium, you pay more for more liquidity, has been inverted. And I started using this a couple years ago myself, just as like a sarcastic, it's an illiquidity premium. There's anybody could buy public equities. There's such a, fancy, it's so great. I have this exclusive access to pay private equity fees. So it's become an illiquid. The less liquid it is, the more of a premium in terms of fees. And I'm using it like a joke. I'm starting to see it show up. People think it is truly that there is an illiquidity premium, that you pay more for less liquidity. How backwards is that?
Well, I think one of the first guys who started writing on this. I wrote a piece called, I think it was titled "The Illiquidity Premium."
See, I thought I came up with it on my own.
No. Well, great minds. When something is just out there, a lot of people will come up with it because it's just right. I'm giving us both credit. We could both be wrong too. I'll say back to you what you said, because I've written about it too. Go back to private equity in the David Swenson days, the 80s, the 90s, when it was an esoteric asset class that people were very uncomfortable with. The notion that you got paid more for accepting illiquidity and the two twin things it brings, opacity as to what your portfolio is currently worth, and inability to get out, or literally to become liquid if you need to, were viewed as negatives. As I say, they were viewed as a bug. Well, in a rational world, and I'm not saying the world's always perfectly rational, but in a rational world, you get paid for bearing a bug. You get an illiquidity premium in terms of return. By the way, it's always complicated because when I first started writing about this, I had a long footnote going through. You can always phrase these things in terms of current price, in which case a premium means you're paying more, right, or in terms of expected return, right, where a premium means you're paying less.
Right.
So you just got to be careful in what you're saying. If it's a bug, you should get a higher return or the same cash flows for a lower price. If over time, and I believe it, I don't know if it's gone all the way. We don't have data. We can't prove this. But the notion that was once a bug is much closer to, or perhaps even on net, a feature where, and they're not crazy when they say it's a feature. Some of it is they know they'll be better investors. They know committing to sticking with this. Mm-hmm. Meaning when AQR is down a lot in a year, they can sell us in a panic. Right. And yes, that is always a very bad idea to sell AQR. Right. But it can be done. And if an investor maybe knows they'll be susceptible to that in public markets, but won't be in private, then yeah, they really might be a better investor. But you pay for a feature. In a rational world, and I do think it's rational, at least in this extent, you accept a lower expected return or pay a higher price for the same cash flows if you're also getting a good feature. And it's a little ironic that something that used to be a bug that kind of started the asset class basically by being a bug might have turned around. Where the net comes out, whether investors are better or worse off for being in privates, if both things are happening at once. If they are better investors, but they're actually accepting a return under the beta that they truly have because of this feature. How it comes out on net is anyone's guess, but that we've moved that way directionally, that the return edge of privates, to the extent people will argue about, this is not my fight. I fight about the denominator. If it's return over risk, I fight about, when people say privates are very low risk because they're not measuring them, that'll get my blood boiling. But there's a separate fight that I'm really a bystander in what has private equity actually made over time. There are a few academics who who say it's been great. There are a few who say it's really not when you do it correctly. I'm not really weighing in on that. But whatever it's been historically, I would expect it to be less now that it's a popular asset class that people want for the very thing that used to be the reason you didn't want it.
Right. And of course, on the other side of of performance is volatility, right, or risk, or however you measure it. And your volatility laundering is fantastic.
Thank
The
you.
common thread.
Little mean of me, but I turned a phrase there.
I think it's fair. I mean, I don't think it's mean. I think it's fair. I think, look,
It could be mean and fair.
at the end of the day, right, there are people who are getting duped by, what would be called volatility laundering. There are people who, and look, I've had these conversations, I'm sure you've had as well. There are people who just look at the standard deviation of something and no smoothing effect, they don't manage it at all, and they buy into it. And there's nothing wrong with somebody saying, look, something's going to be marked more infrequently. I'm fine with that, or I like that. There's nothing wrong. Like you said, it'll keep you invested. But to imply that there's an apples to apples comparison of the straight standard deviation of something that's marked to market daily and something that's marked to, I don't know what, quarterly or sometimes even annually. I mean, it's a totally different thing.
Oh, totally. There's so many different ways to think about this. First, some will be like, what's the harm? What's the harm in saying something's 5% vol, when in reality, if you're marking every day, it's maybe 22% vol? I can think of two ways. One, we've already discussed. If you overpay for that because you think it's so safe that you need it in your portfolio, and then the premium to earning it to what you earn from it going forward is less. But the other is the event no one wants to think about, including me. I don't want a giant 7-year bear market. That's probably not good for anyone's business, even if you're on the right. So you have to be very much on the right side of that. For the wealth effect of that is pretty dramatic. But if there is one, even for privates, there's a limit to how long you can not mark to market. To wake up and find, we were taking 5 times the vol that we thought we were taking, is a sobering possibility. That's only in a really terrible case, because as we've seen, a couple of year bear market, private equity can kind of sail through by not marking very often. But if it's really long term, to wake up and find you had more is scary. Again, there may still be a premium there on net. Being a better investor might still make them money net. The private equity managers I know personally are all, to a person, pretty impressive in how well they understand a company way better than I understand my own company. They're the belief that there's some alpha to their selection and to their active restructuring alpha. I'm not a disbeliever in that. But the idea that some investors may find out at the worst time to find out that they had a fair amount more risk than they realized. The last thing I'll add is no one ever got rich yelling at their own clients, so this is dangerous of me to do. But the way you put it, I think, is mostly right about people can be duped into thinking something is low vol. But I think there's a significant component of I'm okay being duped. Everyone's in on it to some extent.
100%.
And they're doing it with a noble goal. It makes us better investors. We report to someone too. It makes us all calmer and therefore more patient. So I'm not claiming any nefariousness. But this notion that there are these tricky private equity managers fooling all these clients, I think is way of an oversimplification and letting some people off the hook. I probably, in my best interest, should let off the hook, but I've never gone by that.
I guess that's fair. And look, your point about you can't yell, you can't beat clients into submission, you can't yell, you can't insult people.
You can try.
Well, so I think I did, and I pulled the reins upon it in a big way. There were some, products that we were competing against that, we thought were, and again, look, we're not, I see myself probably not so dissimilar to how you see yourself in some ways, where I value.
You see yourself as taller? I see myself as tall.
Not as handsome, but I value to me a mispricing in the market is a dishonesty. It can't stand. It's not right. Like, I want to go out and correct it. And when you see people invested in something that you think there's more risk than they know, I think I'm doing them a big service, right? I'm Paul Revere. I'm coming around, hey guys, danger, but they don't see it that way at all. And that was a tough lesson for me to learn, but I learned it where that's probably not the way to sway people.
How'd you learn it? I never learned it.
I learned it because our assets are about zero in the fund that was to compete against that one. So it was a tough lesson, but it was a good lesson.
Well,
and it's
at AQR, like once every 5 years, somebody says we should come up with a structure and be honest about it, not try to fool anyone, where we say we're going to market like private equity. We're going to And then we run into several roadblocks. One is, in most cases, apparently it's illegal. If you own liquid public stocks, and just to tell people the value is X because we think that's what the value is. Turns out the world doesn't go for that so much. The other is, I think you kind of break the spell. If you make it a little too artificial, even if it were legal to tell them, they can look it up. But one thing that I've always laughed about is, for those who really know and say, I'm doing the private stuff, I think they're great managers, they're going to make money, but yeah, it's much easier to live with. I always ask, once you say it out loud, why is it easier to live with? If you were being duped, I get it. But if you're not, why is it easier? One of the best counterpoints to mine, I find, and I'm introducing this only because I do have a counterpoint, is someone says, hey, aren't the private prices perhaps more accurate? That if markets aren't perfect, and I don't think they're perfect, and there are bubbles and whatnot, the fact that we keep it steady, or reasonably steady, that we market at a lag, isn't it very possible that's a more accurate price we're giving, not a less? To which I'm very sympathetic. But I always say, why don't we get to do that? Any manager, us or a private manager, can mark things at least one of two ways. One way is what I could sell it for today. The other is what I think it's worth. Mm-hmm. Privates, clearly, maybe they nod towards the market current pricing, but it's a fair amount what they think it's actually worth. Public, not just us, anyone trading public, is you market it what you could sell it at today. The funny part is we are both fully capable of doing the other one. If a private manager wanted to give you an estimate of what he could sell it for today, they're great at this. It's what they do. Trust me, if the market crashed 50% tomorrow, which, just so everyone knows, is not a prediction, if the market crashed 50% tomorrow, they'd be able to tell you we can sell what we do for a ton less, and in fact, here's our best ballpark estimate. Conversely, if you wanted to ask us what our portfolio is worth, when we had a horrible 1999 and early 2000 in the dot-com bubble, and we had lost a bunch of money, I could have told you, if we returned to fair value, as I expect to, what do I think this portfolio is worth? We both can do it. Why does one get to do one and one get to do the other? Is a institutional and legal quirk.
Yes. Yeah, interesting. And again, just like you were saying with markets where they don't necessarily reflect, that creates opportunity.
Yeah.
So if the private guys think, hey, the public markets overreact, all right, where's your HFT fund that's selling every pop and buying every dip?
Well, that brings up something else. I'm often thankful for the private market because historically, and I don't know how much you can quantify how much this is the case today, they've often been thought of as the bid for undervalued stocks. Ultimately, the idea that someone could take them private, for value managers, I think has probably historically been a positive force that these people are out there.
Yeah, and that's been playing out in the REIT space, where I've got like probably 8 or 9 hours, so I locked the door and we're going to be here.
Okay.
There's so many things I want to talk about.
Is there water, a bedpan? What do we need here?
I want to go in a little bit of a different direction. The skill of mathematics and quantitative analysis is a hard skill. It's a rare skill.
That's what we like to tell people.
The skill of writing is also a hard skill and a rare skill, completely different parts of the brain, completely different. And you've managed to excel in both. Was the writing a function of just trying to communicate what you found through your research? Was it something that you had to kind of work into when you started AQR? Is it just come naturally? How did you get to become not only a quant, but a writer?
Well, for one thing, I think you're being overly nice to me. I think I'm a pretty good writer, but I think the bar is pretty low in financial writing, particularly if you can inject any humor into something. Humor without substance, you're just a court jester. But if you have some substance and can inject some humor, it actually really helps because it lets people finish the whole thing. It keeps people's attention. And there, I may be the least funny comedian ever, but I'm in the top decile of quantitative investment managers when it comes to humor. So I think the bar is low, and I'm maybe just willing to go there more.
A great comedian for a quant.
I also this I haven't talked about as much. I don't memorize a whole lot. I actually consider myself to have a pretty bad, straight up memory. Um, you're Phil, right? Okay. I rederive things a lot and teach it to myself a lot. And when you do that, I think you get better at explaining things. You kind of force your brain to go through that exercise. So what I try to do, and I'm not saying I succeed all the time, is explaining complicated things both in a simpler way or in a simple way with good analogies and with some humor is the niche I've tried to carve out of those two. But again, I think I'm a good quantitative researcher. I think I'm a good writer. Maybe I'm lucky that good at both is in some sense is competitive with being great at one and terrible at the other. It's a package of the two can be useful.
The footnotes in everything you write, the footnotes are amazing. I never read the footnotes in anything. I only read the footnotes sometimes in your papers.
Well, my footnotes are sometimes as dry as everyone else's, just citing this paper, but it is where I stick most of the humor.
How did that come to? When did you start with putting all the good stuff in the footnotes? When did that come about?
I think that was probably negotiation with some editor. And this is lost in antiquity, in the mist of time for me. But I never wrote with any humor until the dot-com bubble. And I did some writing beforehand, but it was pretty dry. And then having a really tough start to AQR when I was sure we were right, and we did turn out to be right, so I'll ruin the end of the made-for-TV movie for you. It kind of broke something in me. And what ended up being, I think, a good way, but at the time it was like, I got nothing to lose here. I'm going to write sarcastically, humorously, and we'll let the chips fall where they may. And I did that in some working papers and some blogs, but then I started trying to work it in, at least at a much more mild level, into some published papers, a journal of portfolio management type thing. And you want to get any humor in on Frank Fabozzi, you put it in the footnote. And then I just started doing that in general. And like everything else, things become a thing. Right? So if you get known for something and you have some people who are regular readers, they kind of expect it. So now I have the opposite. I feel like if I write something that is completely dry, even if it's, E equals MC squared, which I'm not capable of, but I'm just saying, even if it's the best insight I've ever had investment-wise, I do feel like people are going to be like, but the footnotes were boring. So I'm a little bit a prisoner of my own my own creation there.
But it's a good one to have. The asset management industry is there are people out there who feel like it's being commoditized. It's tough. Margins are coming in, certainly on my side, on the ETF side. Would you start AQR today? Would that be the same direction? Would it look any different?
I would have bought NVIDIA. I don't even know if it existed. It probably didn't, but definitely didn't. Yeah, I would. I think everything is more expensive. Talent is more expensive. The amount of compliance and legal and back office type stuff you need to start a firm is dramatic. We were 13 people when we started as a $1 billion hedge fund launch in 1998. I don't think you could do it with 13 people what we were doing back then. Just what's required of you. Margins are tighter. But I don't think the old stuff has stopped working, and I think we've come up with a lot of new stuff over time. So I think I'd be just as excited. And, frankly, if this business was doubly as profitable or half as profitable, I'm still doing it. Yeah. It's for one thing, I love it, and for another, it's the only thing I know how to do.
You got to do it for love. Yeah, I mean,
I have literally, this is embarrassing in some sense. I've literally done one thing since I was 21. I showed up at the University of Chicago, took Gene Fama's class, learned about the very early work they were doing on value and size, and it's expanded dramatically. It's much deeper. It's much richer. We and others, not just us, have much more complex models. We trade many, many more things, but that's evolution, not revolution. I'm always looking at polymaths and people who reinvent themselves, and I'm always like a little jealous because I'm not sure I could. I've done the same thing now for 36 years, and I don't see another career coming my way.
Well, you know, there are not only anonymous like commentators on the market on social media, but there are now people who are working or starting businesses under the pseudonym. So
I didn't
don't
know
know.
that.
Yeah, there are. I think your friend Jim O'Shaughnessy has hired a couple.
All right.
So
That's both cool and terrifying.
so we see a new account that suffers no fools and
I can't wait till someone launches AQR, the deep fake. I've had Twitter impersonators over time, as many people who are all known
scam accounts, or they're really trying to.
Well, this is a funny one. At some point, I don't know, this is probably 5-7 years ago, I quit Twitter. Anyone who follows anything I do knows I have a bit of a love-hate thing with it. I love the FinTwit kind of exchanges. It's where I met you. But I do have a short fuse when I think someone's being disingenuous or mean or something, and then I get meaner than them, which is a problem. So I said I need to go cold turkey, and I actually closed the account, not just took a hiatus. When I went back eventually, which I did during COVID, partly because I thought I had some interesting things to say, but partly because it was just COVID and I was bored to death like everyone else. In the interim, someone started a account with my exact name, took the background that I used to use for the the picture on Twitter, exactly the same. It was pointed out to me. I looked at it, and when they said, "Do you want us to make them take this down?" I said, "I guess we have to, but they're doing a pretty good job." I haven't looked at this. We didn't make them take it down. Through Twitter, we had them change the name to not Clifford Asness, which I felt that's okay. That's not going to confuse many people. But from what I saw, and again, I've not kept up with it, so if the person still does it and does crazy things, I'm not signing off on that. But during my interregnum period, they were saying things kind of like I usually said. So I'm like, I feel bad yelling at this person. They've actually kind of kept me going, at least a little bit.
That's great. Yeah, I have this one account that I follow. It follows me. It's not Louis C.K., the comedian. Yeah. I can't tell if it's Louis. I'm really not sure. Like I go back, I'm like, is this Louis C.K.? It might be. Yeah. That's fantastic. I mean, it can be so creative. The discussion on Twitter is so incredible.
It's what brings me back. It's so good.
Horrible. I'd say it's really like swimming upstream to stay with. I mean, there's certain people that are just so creative and brilliant, and they're just putting it out there
and generous with sharing their thoughts. No, obviously, I'm mostly exposed to the financial Twitter community, but like you're saying, it's such a powerful force for both good and for horror.
Right. Exactly.
And there are a lot of people. Jim O'Shaughnessy, you already mentioned, is someone who has an ability I've never had to rise above the horror and ignore it and only use it for positive. He's like an idol of mine on a few things, but on that, I see both aspects and occasionally get mired in both aspects.
Yeah, it is great. It is definitely there's a pull. There's a gravitational pull there towards politics and negativity. I have to ask before we wrap. I have to ask. So there was a restatement of data from Eugene Fama, and I mean, speaking of Twitter negativity. So I saw this, and I saw the cumulative chart. So Eugene Fama restated some of the old value data, and on a long-term basis, it looked pretty significant. Now, if you restate the data and you're honest, it's a coin flip whether it's going to come out, good or bad. But it happens to be it diminished the factor a little bit. I posted, and then your response was characteristically not very subtle. You said this stuff is crap, mediocre. Nobody's trying for attention. Value back tests have indeed gotten better over time.
I'm not talking about Fama in French when I say mediocre. Nobody.
And you weren't talking about me either, right? Because it was quote tweeting.
We can leave out the actual names. I don't want to be that mean. But yeah, it did get me upset.
Etc. So yeah. So just help me contextualize this issue.
Sure. I don't hold me to the precise years, but this is probably a 30-year phenomenon. They always work at these databases. I mentioned it earlier when we were talking about small cap, where I believe the factor's gotten weaker. So it can go in both directions. When you look back in time and go, no, we were measuring this wrong, you could do it. It's nothing wrong with going and seeing what those effects were and asking why. I found, and this other people might disagree, but I found when I read this paper, and the paper essentially found that if you didn't update the database, value looks worse. Various versions of updating the database made value look better in the past. They had a tone that at least struck me as Fromm and French have been pulling a fast one on the world. That, and I will mince no words, and I will make this NC-17, that's batshit crazy. These are honest people. This process is not even one I believe they control. This is just updating data and making it better. It was also a fairly trivial effect. You can get a decent T-stat, but it was basis points. So I saw this as a tempest in a teapot from people who exaggerated their results. You know, one way to make a rep for people who don't have a rep is to take down people who have a rep all the way up to a Nobel Prize. And yeah, I've had my disagreements with Fromm and French. I'm less of a fan of the size effect than they are. We just talked about that. I'm more of a fan of the momentum effect. I've debated with them. I once had to present some results on momentum right after Gene at a CRISP conference. And I started my talk by saying I have to do two of the hardest things in academic finance. In general, presenting after Gene is very hard, and I also have to disagree with him. So I'm not above debating these guys. We might agree on 90% of the world, but if we disagree on 10%, I don't say we have to show absolute deference to the OGs of our community, but I thought this was intellectually dishonest attack on them, and a total tempest in a teapot.
Yeah. Well, thanks for making the time today. This is really great. I appreciate this. Thank you to the audience for your time and attention. Where, if people want to read more, follow, if they aren't already?
There's the AQR website. There's something called Cliff's Perspective on it. I would encourage anyone to look at the whole research education part of our website. There are a lot of other people write great things here, but mine is called Cliff's Perspective. And if you're a little bit more of an academic bent, anything I write that can fall into that category, that's not a blog, will be on the SSRN under my name.
Great. Well, thanks again. And thank you to the audience. We'll be back next week.
Thanks, Phil. It was a lot of fun.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.